Welcome to Before the Bell, your home for actionable pre-market content. Good morning, traders. Chris Buss here with Traders Profit Compass with your morning look at markets for Friday, March 4th. It's 6:51 a.m. as I'm starting the video. And don't forget, run your player at 1.5x. A lot to do this morning. Let's get into it. Futures, Bitcoin down 1%, oil up 2%, equities down about 0.75 to 1% as I start the video. Gold's up about 0.75%. Copper's going for an all-time high today. It's up 1.2%. Couple pennies off the all-time high print. So that's kind of exciting for a technician. Macro. Well, of course, we got Ukraine dominating, but we've also got the February jobs report, which might be impactful to the Fed, which meets in 2 weeks. Nothing much on the earnings front. Hibbett Sports is the only one that I saw. Wild night in futures last night. Some of you were in the trading room and saw it. Others might have seen it at home, or you might have missed it. But anyways, Russia bombed or occupied the largest nuclear plant in Europe last night. I think solid facts are still lacking as to what is really going on, but certainly it sent a chill through the futures market last night. And one thing that I didn't realize, and I didn't see it last night, but I was just kind of looking on the map, getting my geography in order over in the Ukraine, and I didn't realize Chernobyl is right there. I thought it was more central Russia, but it's not. So they've had some, unfortunate experiences with nuclear reactors. This particular reactor's got a lot more safety measures involved. It's not the old style Soviet Chernobyl type reactor, but still, a reactor's a reactor, and a stray bomb hitting that or intentional is never a good thing. Also, lot of self-sanctioning out there by countries and companies. We don't want your oil at any price, kind of thing, and that's really going to blow a hole in supply. I heard a figure 3 to 4 million barrels off the global market, just from the fact that countries are taking a position that we don't want to buy your oil. But of course, the U.S. isn't one of them. But a lot of other companies and countries are not. Also, heard an interesting thing that after the Iran-Iraq war, new kind of policies were put in place for maritime shipping insurance, that if there's a war going on, that the vessels, the shipping vessels that would normally go into the Black Sea to pick up wheat or oil or whatever cargo that Ukraine or Russia is shipping out of those ports, are now uninvestable. So, or not uninvestable, uninsurable. So shipping companies are not going to take that risk. If they can't get insurance for their vessels, they're just not going to go in there. And so now, unless it's a Russian flagged, Russian owned vessel, there's not going to be a whole lot of shipping going on out of the north end of the Black Sea. So that's another factor. What else do I got? Let's talk about volatility. That's the title of this morning's episode. I mean, we are just in a pure vol situation. This is a 30-minute chart of the VIX going back a couple months, and there's been a change of character that I want to bring forward. Usually, on the VIX and in the market, you get a volatility or risk off event. That's what happened. This is back in the February time frame. We're bouncing along in the mid to high teens, and then you have a 2 or 3 day vol spike, and they pull the rug and scatter everybody in the market, and then you have a high, and then it starts to come off. If you go back in time on the VIX chart, you'll see this characteristic spike and then a bleed off in volatility, because that volatility is hard to maintain from the standpoint of holding it at a high level. Usually you get that peak and then it's difficult to maintain, and then it bleeds off. That's why a lot of people, when they get that vol spike, they'll buy puts on the VXX or other volatility products because of this characteristic move down. But look how it's changed. Now, instead of we had a little vol spike here, and then it came down, but then there's another one. Then it comes down hard. Then we've had another one. So we've actually built a rising channel of volatility. And so now, we had 2 days ago, we quote, had an up day. That's this leg down in volatility. Then we've had chop over a couple days, and now we're right back up to 34, 35 this morning. So this is not what you would call a traditional volatility environment, and you wouldn't call it really an investable environment. Just from a technical standpoint, you could easily have a move up to the top of the channel. Think of this just like price on a stock chart. We've already had 2 touches of the top of the trend line, actually 3 going back here. So we could easily have a move into the high 40s kind of move up into the top of this thing. So you don't want to be sitting there in a 30 vol or 35 vol environment picking off, I want to invest in this company, I want to invest in that company, as a IRA type of thing. You want to wait till vol starts to bleed off a little bit, or at least you have confidence that the quote bottom is in. And we don't really have that right now. I mean, just imagine if we're sitting here on a Friday morning, with our positions and everything. I mean, just think about that weekend risk, that if, we go home and everything's, pretty docile, and then they put a bomb in that reactor. I'm not saying that happens, but I'm saying some weekend event, and you come into a 4% rug pull Monday morning, that wouldn't be pleasant. So what I want you to think about today is, number one, we've been saying for a while, cut down your positions. The positions that you have open. Number two, trade smaller. You certainly, think about that weekend risk. You don't want to put everything at stake over the weekend, or decide if you're going to add protection with out of the money puts or something like that, some short exposure. I really think this is, and we talked about it a long time before, a long short environment. Certain things that are working, we're in a lot of those sectors that are working, steel, commodities, precious metals, grains, stuff like that. that, it's not the high-tech stuff. So just think about how you want to handle that this weekend. And then from a market perspective, don't forget that how trading goes between 2 and 4 o'clock this afternoon is going to tell you a lot about risk sentiment. Do they just totally bail on the market and send it down because nobody wants to be long over the weekend? Or do they kind of rally the troops, circle the wagons, and kind of hold it where it is, or even go a little bit higher? We'll have to wait and see. Getting into the charts, I put together something just to visually show you the defensive market regime that we're in. And what I did was basically plot the defensive sectors of the market, the spider sectors, against SPY, and see if that ratio is rising or falling. So if you're plotting utilities against SPY and the ratio is rising, that means utilities are outperforming the index. Same with healthcare, rising relative strength, relative performance profile. That's defensive. Staples are outperforming the offensive consumer discretionary. That's defensive. Staples versus SPY rising. That's defensive. And then lastly, SPY versus QQQ. When you have periods back in time, back in the market, when SPY outperforms the NASDAQ or the Qs, those have been either very choppy times or outright bearish markets, because the Qs hold a big basket of offensive, higher beta stocks. And in SPY, yes, you have offensive sectors like financials and consumer discretionary and technology, but they've also got a lot of defensive sectors. And then what people do is they take their money out of the NASDAQ and try to find hiding places in the SPY sectors. So we've definitely got a defensive market regime, and if you are long certain things, make sure they're either defensive or non-correlated with the market as a whole. And what I mean by non-correlated, what does corn have to do with Facebook? Not a whole lot. What does copper have to do with Apple? Not a lot. So I think we're, at least what we've been doing, is trying to stay outside of that. And if you're new to the channel, first, welcome. Appreciate you being here. But if you find yourself in tech, in high beta type stuff, I think that's a real dangerous place to be. Well, Chris, what are you talking about? It's already been knocked down 80%. And, that's okay, because it's still probably trading at a ridiculous multiple, and these guys don't care. Any kind of TA person will tell you, you short 52-week lows. I mean, you keep shorting stuff until it stops going down. And stuff like Kathy and some of these other software names, they've just obliterated. They're going after them again, and they don't care. They'll take it down 95%. As long as it keeps going down, there's going to be people selling. And I really would stay away from trying to bottom tick that. So, because you'll get run over. I don't think we're even near where this thing is going to settle out. And remember, I don't think you're going to get a V bottom in this stuff. If you really like certain software names, I think you're going to get an opportunity for a base to form and then, come out of it whenever that may be. So I don't think you need to rush to get like I said, the bottom tick. So moving on to SPY, we're going to open at least now around 432.5. I think that's going to be your pivot today. Back down below the trend line. Rejected here at 4,400 right when the market opened yesterday. They sold the opening bell and took it down back below the 200. So just from a technical standpoint, it's not bullish. The best way to describe it is choppy. Choppy to bear market action. Notice on the daily chart, bearish regime on RSI, bearish regime on PPO, back below the trend line, back below 200 moving average. That's a bunch of check marks for the bears. Here we are on the 2 hour. Had the little fake breakout right at the open, and they came right back and just chopped all day. Now, you can see I've got the 432 pivot here this morning. That'll leave a gap above on the open. If we open down in here, we've got a little gap below, and then we'll have a gap above. Treat that like you do any other gap on the open. Be ready for it to fill, or they may go the other way. But if they take it down lower, mark your gaps early in the session in case they try to come back up at a certain point and fill that gap. But you can see here on the 30-minute chart, we've got a little level at 430 at the bottom of this prior gap where you could get a bounce, and then you've got a more substantial level here at 428 where we spent quite a number of hours just the other day, and then we had some reaction lows over here and back here, and so that brings into focus 428 as a really, really important level on your charts this morning. Qs, same thing. Rejected by the 20, brought it right back down. I think 340 is going to be an important level. Bearish PPO, bearish RSI, threatening this steep downtrend line. You can see all the reach downs to 340. I think that's going to be an important level today. We've been in this consolidation range in the SPY 2 hour. Here was your bull trap fake breakout. And then they brought it right back into the box and slammed it right down to the bottom. You often get, remember what we say, that you get fast moves from false moves. Fake breakout, false move, back into the range. What do we always say? Once you're outside, you don't want to go back in, because once you go back in, you're going to the bottom of the range, and that's exactly what happened. If you're a nimble trader and you understand that principle and you're paying attention, that's your default go-to playbook for that type of a situation. And if you got that, kudos to you. Like I said, 340's going to be your key line this morning. If they break it down during the day, I kind of see 336 coming in pretty fast, and we held that at least for a little while back here at the end of February before this whole thing let go. IWM daily, trapped in this $20 box. We had a little move to the high of the previous day, and then they pulled the rug, as we've been talking about for many days and weeks. IWM has been the weakest. Everything's pointing lower, and we've got to assume that until, at a bare minimum, we see some type of bullish price action, and we really haven't seen it yet. All these moves, while certainly tradable, they're not investable bounces because we're still below all the moving averages. We're still below the downtrend line, and we've still got 1 year overhead resistance at 210 that hasn't been taken out. I show on the pre-market, we're down here, going to open right at the 200 level, right at the downtrend line, at least the way I've got it drawn. And then so if we break lower, then you got really $2 increments, 198 and then 196, and then things fall away pretty quickly below that level. You see voids in the chart here and here during these runs down. So we'll have to play that by ear, but don't discount the possibility that we could go down pretty fast. And just as I'm speaking here, if you've got a decent amount of long exposure, even if it's just for today, I mean, you can get short either other, like the ARC names or whatever's breaking down, just as a hedge. If you don't want to close out your long stuff, if you see stuff starting to waterfall, or like I said before, in your planning for the weekend, if you decide you're going to plan to hold stuff over the weekend, what I would do is try to get that protection early today. If you're committed to holding stuff over the weekend, why? Because I think there's a much higher probability of them selling the close than buying it. So if you wait till 2 o'clock to buy puts and we're already down whatever percent, they're going to be a lot more expensive. And what I would do is get that early, and I would buy a spread for the reasons that we've already talked about, a put spread, because the IV is going to be expensive, and at least if you spread your position, you can sell one leg of the option to gather some expensive premium. 30-minute chart, I got a little thing here why I draw the lines. That's why you keep track of your gaps and everything. Multiple touches up here, rejected. I've got a little trend line off the floor that we've broken below, and now we're down around 200. So I think that should be your pivot today. Going to race through FATMAAN, not a lot of big changes. Facebook is just toggling around. Given these moves have gotten smaller and smaller, I mean, I think if you're trading Facebook, I think you got to knock that down to a 30-minute, a 15-minute, a 5-minute chart where you can get some resolution on the candles. Apple, they keep holding this up there. I'm not sure why. It really has not been phased. We had a run at 168.5. They sold that immediately and came back to 165.5, the top of this flag structure. Everything is intact. Probably one of the strongest, technology names out there. It really has not been clipped by this. But if they do come after it, first move this morning, something below 165.5, I would anticipate a run to 163 and into the weekend. If they're all in sell mode, I think you can get short at 163 if you wanted to, and look for a move down to 159. But if you're committed to that play and you see price wrestling with 165 and a half, and you got it in your mind you want to short Apple, I'd short it here. I mean, why wait to come down to 163? If you think it's going to go lower, it probably will from here, and then you may get a little bounce at the top of the old gap. If you do, you still already have a winner, and if you don't, you're already in for a bigger move. Tesla, bad day at the office, down almost 5%, lost this 860, lost the 200. From a swing or just market perspective, that's bearish. You need to now focus on downside targets. I have the first level of support at 830, and then back to 800 where there was some prior support as well. And of course, if you don't like that premium, you can look to ARK Flagship Fund as a proxy trade for being short Tesla. Microsoft, here's another example of that fast move after a fake move. We had talked about 300 being an important level of resistance. Broke above, failed, fake breakout, back below 300, back to the bottom of the trading range, all the way from 300 down to close to 294 on the low of yesterday. Another example of a fast move after a fake move. Actually got me in yesterday morning, so that was quickly a losing trade. I did not reverse it here. Don't know why, just didn't. Got out of Microsoft with a loss, and just watched it go down. I think today you just key off at 393. It'll probably either open just above or just below that this morning, and then you can handle your gap. Very bearish price action in Amazon. Had this. Here was the fake rally right up to resistance, downtrend resistance, where it failed yesterday. That was a great, if you were thinking that way, that was a great place for an entry. Your second entry was on the break of 30.30, bottom of this flag. Got the fast move down to the next level. Bear flag, broke the level, right down to the next level. I mean, and this is the power of having your levels. You're not guessing like, where's my next target? Am I going to get a bounce? Where's this thing going to stop? Where could it rally to? Well, here was your rally. Came right back down to support, broke support, down to next support, baby bounce, blah, 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 blah. Just right on down. So today, below 29.50, I think it goes to 2,900, basically $50 increments on the way down, right on down the line. So that looks pretty bearish to me. Google's held up pretty well. Remains in this consolidation flag. Key off of 2660 this morning. If it loses that, probably going to come down here to 2615. Don't forget, Friday, if you're lottery players, key on the stocks that you want to focus on. If we get rolling downhill like really fast, if you got a lottery ticket to the downside, that'll kind of mitigate the pain you might be feeling on the long side. So that might be something you want to consider. Just remember, they are lottery tickets, and most of those end up being worthless. I've gone out to the weekly chart on Netflix. You can see kind of where we're at. You got a big line of demarcation on the weekly at 350. I think that's the next level for a potential accelerated breakdown, because the chart opens up to the downside with targets at 300 and 260. Semiconductors opened right at the top of the box yesterday, and they sold it from the opening bell right on down to the bottom of the box where you got a bounce, and then they closed right on it. So anything below 262, I think you got to be bearish. You're below the downtrend line. You're below this big consolidation. You've got one level of support here at about 256.50, or excuse me, 257.50 right here. And then you've got a little minor support shelf here at 254. Those would be my downside targets for a move. And then you've got the prior low down here at around 248 if things get ugly. Now, if we go down in the morning and then recapture 262 and the downtrend line, that's near-term bullish, and you can try a long. But I think at this point, well, by definition, it's a counter trend move. Lower highs and lower lows is a downtrend, and if you're trying to be long, you're going against the trend. Not saying it doesn't or can't work. It works all the time. Just remember that the bounces will be short-lived, and they are places to fade, not add to. Quickly on ARCF, I just want to show you the levels, and I did mention in the blog post this morning that I had a frustrating couple of days. On Wednesday, I don't know if it was ARCF or ARCK, I think it was K, but all the charts are the same. We had a little breakdown, and then remember we had the rally on Wednesday, and then so I got stopped out relatively quickly for a loss, and then the next day they take it down 5% without me. Now the lesson is not to come away with, oh, the market sucks and it's really choppy. If you get stopped out of the trade and you're interested in it, you got to realarm it. Realarm the level that you want to re-engage to the short side. And then if you get another trigger, whether it's the next day or in 3 weeks, then you're ready to go and you won't miss it. And that's what I failed to do. I got short, got stopped out, but I failed to realarm the position. And then by the time I realized it, the nice entry was already gone. So I think you can stay bearish below 28.50, 29 on ARCF, looking for lower prices. ARCG, really, nice technical action if you really want to think about it. Got a breakdown and then comes right, almost got a touch of this trend line, and then they rolled it over again. So on ARCG, I think your number is right here at 44, and you can look at the 60-minute charts to fine-tune this, and here we are at 45. You can see there's a shelf of support right in where it's at right now. I think if it breaks down, you're going to go down here to 43 for another test of these lows, and then potentially lower. ARK-K, here's what I was talking about. Came right up here, stopped me out, then rolled over without me. So we're down below key support and nothing really left below except to retest down here at 57.50. ARK-W, same exact pattern. Rally up into the moving averages, get rejected. Now we're down below 84, and I think that's a short. I think regardless about however much Kathy's funds are down or these high valuation names are down, I think they're still going after them, like I said earlier. And don't think for a minute, I mean, these things are already in a bear market just because the broad markets really can't be characterized that way. These have shown no signs of strength at any time since November. So, like I said before, you keep doing what's working, and what's working on the ARK names is to be short them, aside from any tactical bounces that you want to get out of. That's just tactical stuff. Strategically, you want to be fading the strength in ARK-W, because I think the powers that be are going to keep hammering those names until no more blood comes out of the stone. So don't think that a stock that's been knocked down can't go even lower. So let's wrap it up. Ukraine and volatility dominating. Be careful on your position sizes. Be careful on the number of positions you have. Make sure you got a game plan going into the weekend, and we'll watch that market sentiment the last 2 hours of the day. I think it's going to be really, really important. We still have the Fed in 2 weeks. We got the February jobs report here this morning, and I think it's going to be another volatile day. So buckle up, put your helmets on. If you're not comfortable, step aside. The most important thing right now for any of us is to preserve our capital. If you find yourself being chopped to death, scared, not quite sure where you want to be, the best move is step aside. Preserve that capital till we get better market conditions for either investing or swing trading, that kind of thing, and let the vol settle out, because it will. So anyhow, I hope you found the video helpful. If you're new to the channel, thank you again so much. Hit the subscribe button, the alarm bell. You'll get all my YouTube content. And then look over in the show notes. Join the team. You'll find a link there to the blog site where you can drop in your email. And then morning, noon, or night, over the weekend, you'll get updates from me, thoughts on the market, trade ideas, trade management tips, the whole 9 yards. And the cherry on top is an invite to our trading room, where we'd love to have you. Got a lot of new guys coming in lately. It's good to see them. And gals, we got gals in the trading room as well. So don't be bashful. We'd love to see you. This has been Chris Buss with Traders Profit Compass. Be careful, trade well. Talk to you next time.